Hello and welcome to Pro Trader Strategies Market Commentary for Wednesday, April the 17th. My name's Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Please take a moment to read over this disclaimer. Basically, it says, because I don't know your risk parameters, I don't know what's in your portfolios, I can't, therefore, give you investment advice. I'm also not registered, so therefore I can't give you investment advice. And bottom line is, do your own homework. Past performance of any trading system or methodology is not necessarily indicative of future results. Having that out of the way, what I'm here to do is teach you some different option strategies, but it's up to you to implement it into your own portfolios in your own way. All right, having all that out of the way, let's get it on with some economic data. We've got some stuff across the pond. We basically got our average hourly earnings index came in at 2.8%, expected to be 3%, a little bit lower than expected there. We also got unemployment rate out of Great Britain, came in at 4.2%, expected to be 4.3%, so lower than expected there is good. We also, here in the United States, got building permits came in at 1.35 million permits pulled. It's a little bit of a gray area. It's expectations that they're going to build, but it's not always the case. They can pull as many permits as they want. Housing starts, though, did come in at 1.32 million. Housing starts expected to be 1.27 million. And I've been seeing some chatter out there that there is a demand for new homes versus the existing homes. So there's some demand for that. Could be why the permits is being ramped up and housing starts being ramped up as well. Finally, we got we got capacity utilization came in at 78%, expected to be 78%. Industrial production came in at 0.5%, expected to be 0.5%. And then we also have Fed member Williams speaking. He's probably done speaking at this point. And then later on, we have Quarles is probably speaking right now. All right. So, and then Bostic is the one that is later on today. That guy is on a world tour, I think, for trying to find people. Anyway, to talk to. Crude oil futures are down by about 10 cents, but you can see they're sitting right on this 38 Fibonacci level that we put in there. This is the Fibonacci extensions. I probably should go in there and change those versus what the other ones look like. But basically, you just go in and change it. And usually extensions I throw in there as the gold. And I'll finish this up a little bit later, but I just want to give you guys a brief look at what it would look like. I don't know if any of them are going to show up by the time I get done with this, but I'll just finish them up so we can get it done. But yeah, change those out so that you can see where the differences are is what I like to do. I haven't done that in a while because I kind of knew where they were. But you can see on this 38 Fibonacci level, we are just sitting right on it. Settling above that would be a huge win for the bulls. It looks like it's trying to hold its weight above there. It's trying to tread water. That would be a big win for the bulls. Plus, with that doji, would look very bullish. Gold coming off just slightly today. I'm seeing a lot of banks are starting to hoard gold across the pond. A lot of banks wanting to get into that. I think they're probably feeling like the crypto thing is going to try and take off and then fail is my only guess with that. We do have cryptocurrency with the Bitcoin up about $160 right now. We've talked about this time and time again, 23.6 Fibonacci level right there is what we're looking at. So the 9,300, let's call it, they're going to want to settle around at least above 9,250 for the bulls to be able to celebrate a win there. Then on to the VIX. The VIX keeps tumbling down into the 15s. You know, I'd like to see it stay elevated for at least their earnings, but we're not really seeing quite a bit of that going on. And that's usually the case when we start seeing a rally. Let's talk about the Dow Jones Industrial Average. Piercing above this 23 Fibonacci level. It's gotten above the 50-day moving average, which we talked as resistance. Now it's pushing up on the point of control where the most time and volume has been spent. This actually should kind of move. I don't know why it's way down there. It definitely looks by looking at the chart that this is where the point of control for the time and the volume is to me. So that is going to act as a magnet where it could want to start settling down right here. Plus it's right there at that 23 Fibonacci. It might not act as much of a resistance here. Now that we're getting that volume picking up, it could just start toggling back and forth around it because of the point of control where the most time and volume has been spent is going to kind of hold it there. Because when people aren't making money and aren't losing money, they have a tendency to be very complacent. And that's what we're going to probably see here with the Dow Jones, at least for the short term. Now with the NASDAQ today, you can see we've been talking about this 23 Fibonacci lining up with this other 23 Fib here. All of those two lines coming together along with the 50-day moving average should act as a major resistance on the way up. And we saw it really slow down as we got closer and closer to that, as the market started feeling that downward pressure right there, as the bears started defending that. Today, it looks like they've kind of given up on that, and boom, we've just blasted off right through it, just like a hot knife through butter. Similar situation with the E-mini S&Ps. We can see that the E-mini S&Ps were having trouble getting above that 50 Fibonacci. We also had it lined up with the 38 Fibonacci here. A couple other, the 61 as well. Those, once we got above that, it was pretty much pretty easy pickings. We are going to see a little bit of volume trying to defend this 50 area, but it looks like we're above that. So keeping that line in the sand on our radar right there at around 2,700. Bulls want to settle above 2,700 easily in order to rejoice, as what we talked about with the NASDAQ and the Dow Jones Industrial Average. Now the E-mini S&Ps on a 30-minute chart, these are 30-minute candles. We pierced above the 50 Fibonacci right now. So a small win for the bulls. To stay above there would be a major win. Again, same mantra. These are the levels we need to get above in order to continue to the upside. All right, a couple of things I wanted to talk about. Adobe, I really got to keep an eye on it because it is like a triple top here. Now remember, I have on an iron condor in here, and it's been working out very well. Not quite near 50% of my max profit, but I'm probably close to maybe 30, 40% of my max profit. I'd have to do the math on it. But pretty close to pulling the ripcord on this. We pierce above these two lines here, where it's the 100 Fibonacci, which is the 52-week high, and the it's actually a little longer than 52-week high probably. And then I've done the extensions based on the bottom to the high to this retracement here. So that makes that 23 Fibonacci line up quite nicely. That is going to be a big line in the sand to get through. All right, wait, one thing I wanted to talk about, something I added yesterday I wanted to talk about on this Adobe chart. I got to switch it over to Deer because I added something late in the day in my margin account to the upside with Deer, ticker symbol DE. I went and sold the May 120 puts in there for, I covered the May 120 puts in Deer for 35 cents. I originally sold those for about 80 cents. So got a directional move. You can see implied volatility starting to come out a little bit. Was able to cover that for slightly better than 50% of my max profit on that. Netflix. This is an earnings trade I did for both my IRA and my margin account. And let's talk about my margin account first. I went in Netflix and did the April that expire on Friday. All of these earnings trades I did on the April monthlies that expire on the 20th. And in Netflix, I did the April, sold the 260 puts in there for $1.08. I was able to buy those back with that big move higher. And you can see volatility crushing out of this particular one for 4 cents. So that was a nice trade. Didn't add it to my IRA because I had to make a decision. Do I want to add 2 earnings trades or just one? I really wanted to add Netflix, but I thought better would be to increase my probabilities of success by creating more occurrences. And therefore, I just did the next 2 in my IRA. So I skipped out on the Netflix for my IRA, or for my IRA. I did it in my margin account only as a naked short put. Now, on to Goldman Sachs. Goldman Sachs, I was looking to play to the upside, and I did. This is why I talk to you guys so much in these earnings webinars as to why it is so important to cover these trades immediately on the open, because you just don't know what's going to happen later on in the day. Goldman Sachs, a perfect example of that. As a matter of fact, I got caught into having to chase this was looking quite nicely. Let's talk about this first. What I put on in my margin account, I went in and sold the April 250 puts in there for 96 cents. And with this trade right off the bat, I put it in for a 28-cent bid, which I was about 3 cents off, maybe 2 cents off the mid-market on that, and the market just started coming out. So I started chasing this. Had to pay up to 43 cents to get out of that trade. So about 50% of my max profit, but it was a little bit shaky there. I was chasing that one in both my IRA and in my margin account. So over in my IRA, I did the April, sold those same 250 puts in there for, but I defined the risk by buying the 230 puts, only just to limit my risk, and naked puts are margin hog, and you have to basically be cash secured puts in an IRA. So with that being said, I sold those for 81 cents, bought back just the 250 puts for 46 cents. So I got those a little bit later, obviously, than I did with my margin account, as I was blinking back and forth between those two. And then finally, we're going to be looking at Johnson & Johnson. Played this also to the upside. Again, similar situation. We opened up higher and the market started falling out of bed. This is one of the first trades I covered this morning, so I was able to get out of it before the slide. And Johnson & Johnson again went into those same April and sold the 227 puts in my margin account for 43 cents. Bought them back this morning for 18 cents. That was my margin account. IRA, I went in and sold the 127 puts in there and then bought the 118 puts for a total of 39 cents. Bought back just the 127 puts for 18 cents this morning. That was before the sell-off, obviously. You can still get out pretty good. I was even watching in at least Johnson & Johnson with the volatility crush coming out. The directional move wasn't really hurting that bad, as opposed to Goldman Sachs. It was like, it felt like it was upticking at a nickel at a time for a little while there. But out of all of those, nothing else to talk about necessarily for today. That's about it. Friday's webinar is going to be on the poor man's covered put, so check that one out, especially in a bearish market or a bearish underlying. If you're bearish something and want to take advantage of a correction on a move or something like that, this is a great strategy for that type of situation. I'll show you how to implement a strategy like that where you have no extrinsic value. We'll talk about extrinsic value and intrinsic value in that as well. But at the end of the day, give me a thumbs up or a thumbs down on this on this video. Tell me what you like or dislike. If you're giving me a thumbs down, definitely tell me what you're disliking about it, because then I can make some changes. And if you're not liking it, maybe somebody else isn't either, and we'll all be happy. Okay? That's about it. If you can't take that, take it easy.